WatchGuard Capital. Invest your time wisely.
Hi, I'm Stephen with WatchGuard Capital, and this is Estate Tax Part 5, The Fix, where I present ideas to align our estate tax code with capping or at least reducing national debt. If you missed Parts 1 through 4, here's a recap. You only had to file a return in 2016 if you died with more than $5.45 million in assets. 13,429 Americans died with more than that, and 2,693,168 Americans died with less than that. Those Americans with estates over 5.45 million had combined assets of 197 billion. But there are a lot of deductions, credits, and exemptions available to reduce your estate tax bill, so 7,963 of those estates ended up not having to pay estate tax on their $91 billion of assets, leaving 5,467 estates owing an average tax bill of $3.7 million each on average estates of $19.3 million, a lower effective tax rate than the combined federal taxes due on your first dollar of ordinary income, which brings us to the fix. In 2016, individuals could pass unlimited wealth to spouses or charities to reduce estate tax bills, and could also pass $5.45 million to anyone else with no taxes due. With portability, a couple could pass $10.9 million tax-free. In 2020, the personal estate exemption, or the amount individuals can pass before owing estate taxes, grew to $11.58 million for individuals and $23.16 million for couples. By contrast, in 2020, the amount individuals could earn before owing income tax, which is the federal tax that you're familiar with, by taking a standard deduction on his or her income tax return, was $12,400 for individuals and $24,800 for couples, or about 99.9% less than the basic deduction for estates. Estate exemptions, or the amount that you can pass without taxes, are now approximately 10 times higher than any other time in history since the estate tax was implemented in 1916. And as a reminder, our national debt and unfunded liabilities are also at the highest point in history. So here's my proposed fix. Index the estate tax exemption as a multiple of our nation's median income or standard deduction. What does that mean? The median income, or middle American income, was about $69,000 in 2019, and the standard deduction $12,400. If you thought it was fair to allow states to pass 10 times the median income without estate tax to heirs, the personal exemption would be set at $690,000. If you thought it was fair to have the personal estate exemption at 50 years of standard income deductions, then you would set it at $620,000. Both of these numbers are a little low historically, but that's how it would work. If we made the personal estate exemption between 15 and 20 times our median income, it would be between $1 and $1.3 million. If we made the personal estate exemption between 80 and 100 years of standard income tax deductions, it'd be between $1 and $1.2 million. As it stands, the current estate exemption is about 350 years of median income and 1,870 years of standard income tax deductions for couples with portability, which is probably too high given our current levels of national debt. I selected 20 and 100 because that's on the high end of what the personal estate exemption was between 1916 and 2001, but lower than the levels established after 2002 when we lost our collective mind about national debt. Why? It works, because it ensures a rising tide lifts all boats. If our median income as a country goes up, which should be something we're all striving for because it implies a healthy middle class, the estate exemption would also go up. If the standard deduction goes up and people earning income pay less in taxes, people inheriting other people's assets would also pay less in taxes because the estate deduction automatically goes up. This multiple can easily be changed if we want to be more generous if national debt starts going down. So we could easily increase the estate exemptions to 50 years of median income or 500 years of standard deductions if the national debt crisis subsides. Why it doesn't work. First, you don't understand our tax code, but you think you do. Second, it increases estate tax bills by reducing personal exemptions, which is partially offset by recommending a lower estate tax later on, but no one likes higher taxes even if you wouldn't know about it because you're dead. Third, people will try and use the narrative that families will have to sell the family farm to pay estate tax, even though farms only made up 3.7% of total estates in 2016. Fourth, people will try and use the narrative that a surviving spouse will have to sell the family home after becoming a widow, even though personal residence only made up 5.4% of total assets. To further combat that narrative, I ensured the recommended fix on the marital deductions covered homes, cars, and retirement accounts so that assets can pass tax-free for 99% of Americans. And if you're in the 1% group and don't want to pay taxes, let's discuss life insurance. Fifth, people will try and use a narrative that it's un-American to tax people who died with assets in their possession because they already paid taxes on them. Why should we have to pay any more? Which is not true because most assets deferred capital gains on appreciation, and the cost basis is stepped up upon death, eliminating the ability to collect deferred capital gains taxes forever. And if you don't understand that statement, don't use that narrative. Okay, so let's move on to tax rates. Graduated rates from 18 all the way to 39% on the first million, 40% on taxable amounts above that. But if we consider all the tax loopholes, the real effective tax rate is somewhere between 18 and 20%, which is supposed to be the tax rate on the first 10 to 20,000, not the whole shebang. Historic estate tax rates were between 40 and 80%, but let's be honest, when tax rates are that high, people have a real incentive to avoid those taxes. So I'm going to go the opposite direction and recommend to reduce the tax rate and implement a flat tax of 25% on all taxable amounts. Example, in order to promote transparency of our values, efficiency in our tax code, accountability in our laws, and democracy in our lands, a flat tax rate of 25% shall be collected on all taxable assets of estates. Why it works, it keeps it simple, stupid. Current policy, proposed policy. No taxable assets, no taxes due. Got taxable assets, multiply that number by 25% and that's your bill, which is 15% lower than the top estate tax rate right now of 40%. Why it doesn't work? Some people will get mad and say the rich aren't paying enough under that plan. Let's get them. Without realizing that this flat rate is higher than the effective rate currently structured, and that I'm removing or capping deductions to broaden the tax base, which is a page right out of President Reagan's playbook to increase economic growth. And if you don't like this tax rate, that's cool. We can just adjust it in the future up or down depending on what's happening with national debt. Okay, moving on to estate debts and mortgages. Current policy. Debts and mortgages are 100% deductible from gross estates. The fix. No change in the deductibility of debts and mortgages because it's already good to go. But let's increase accountability and reduce fraud. Example, debts and mortgages are 100% deductible from gross estates. Any estate or related party found creating fictitious debts or contracts to avoid estate tax will forfeit the right to this deduction and the estate's basic exemption, and will incur a penalty equal to the attempted fraudulent amount. Whoa, now that's a penalty, but it's fair, and if you cheat, you lose. Why we need this extra provision? Basically, if you eliminate tax loopholes, creative people like myself can always figure out how to make one, and you're going to have to try a little harder to discourage the practice of taking creative liberties. We need an honest tax code, and we need honest citizens, because according to Plato, when there is an income tax, the just man will pay more, and the unjust less on the same amount of income, and that shouldn't be. Okay, let's move on to funeral and burial deductions. Current policy. Funeral, executor commissions, attorney fees, and other expenses are deductible from gross estates subject to state allowances. The combined average deduction for those four categories was $389,000 in 2016, and ranged from $193,000 on the low end to $2.25 million on the high end, which saved Americans $77,000 to $900,000 in taxes in the 40% tax bracket. The fix? Just like personal estate exemption, let's base the deductibility of these expenses on a multiplier of years of our median income or standard deduction.
Funeral, executor commissions, attorney fees, and other expenses are deductible from gross estates subject to state allowances, but are limited to 3 years of our median income or 15 years of our current standard deduction.
So if you want to spend $59,000 on your funeral, that's cool. You can, but it comes out of your $198,000 cap funeral deductions. If you want to pay an executor $181,000, that's cool. You can, but that only leaves you $17,000 to claim for other expenses. If you want to spend $103,000 on attorney, that's cool. You can, but that only leaves $95,000 to claim on other expenses like appraisers. On average, only estates with $10 million or more of taxable assets would be impacted by this change, because estates below $10 million only had deductible expenses of $194,000 on their 2016 estate tax returns, $4,000 less than the cap. Why this fix doesn't work? If someone prepaid these expenses, the assets would no longer be in the estate for tax consideration, so indirectly they would still be deductible, which is okay. We need to get to a point where we accept that at some point in wealth, it's okay to be expected to cover 100% of your expenses and not be subsidized by tax deductions or credits. Because like Cato said, even though work stops, expenses run on. So let's move on. Bequest to surviving spouse deductions. Unlimited bequests to spouses are available, which I don't think most people understand the division of spousal property, so let's do a knowledge check. Bobby and Nate start a very successful air transport company that grows to be worth $22 million. They each own 50% of that company, or $11 million each. Unfortunately, Bobby dies in a tragic plane crash in the year of our Lord 2020. Only his half of the company, or $11 million, might be included in his estate. I say might because if Bobby was married to Kate and they jointly owned the half of the company, then each of them only owns a quarter of the total value. Let's say they also owned a $2 million home, a $2 million bank account, and $4 million in investments. Only half the house, half the bank account, half the investments, and a quarter of the company would be included in Bobby's estate. Kate's half of the assets and her quarter of the company do not get included in Bobby's estate because those are her assets and she did not die. But now let's pretend that Bobby started the company with Nate before he married Kate, and he made her sign a prenup. Or he started it with assets while they were married, but from money he inherited from his parents, and he decided to keep her out of ownership of the company. Then he does truly own his half of the company, or $11 million, and it would have to go through his estate process because he didn't include her on ownership of the company on purpose or deliberately. Thus, Bobby's estate is either $9.5 million if he included Kate in the ownership of the company, or $15 million if he excluded her. Kate's assets are $4 million if she didn't own a portion of the company, and $9.5 million if she did. In 2020, $11,580,000 could be given to anyone, a friend, a child, a wife. It doesn't really matter, and no taxes are due. So if Bobby's estate is $9.5 million, he doesn't even have to file a state tax return if he doesn't want to. But he still might want to send any unused portion of that $11,580,000 exemption Kate's way to be used in the future. But because his assets are below the threshold, no estate taxes are due. If his estate was $15 million, he is $3,420,000 over the $11.58 million exemption threshold. Bobby can avoid estate taxes many ways, and here is one of them. He could give $11.58 million to his daughter April and bequest the remaining $3.42 million that is over the taxable threshold for his estate to his spouse Kate. Since unlimited deductions to spouses are allowed with no taxes due, he could have given Kate $3.42 billion and no taxes would be due. But Kate's worth is now $7.42 million, her $4 million in marital assets plus the $3.42 million she just received from Bobby. Time passes, her assets grow, and she transfers $11.58 to April in the future, and no taxes are due there either. Now let's check over. In 2016, the average value of the personal residence that Americans declared on their estate tax forms was $1.1 million and ranged from $800,000 to $3.5 million. The average value of other real estate owned was $1.9 million and ranged from $1.1 to $11.8 million. The average value of cash in accounts was $1.2 million and ranged from $600,000 to $9.5 million. The average amount of publicly traded stock was $4.1 million and ranged from $1.8 to $36 million. All other assets were $6.4 million on average and ranged from $2.3 to $89.9 million. Thus, the average gross assets of an estate were $14.7 million and ranged from $6.6 to $150.7 million. Bequests to spouse were $9.8 million on average and ranged from $3.5 to $96.1 million. And if these bequests were from joint property, it means that another $14.7 million in assets was owned by the surviving spouse and didn't have to go through the estate process upon death of the first spouse. As a financial planner, I can construct a very comfortable living on that amount. And if the bequest was from separate property, it means the assets were not acquired during marriage or by the effort of the surviving spouse, which reduces his or her entitlement to them. In either case, I think it's very reasonable to cap this deduction under the same provision as before, and to base the marital deduction on a multiple of years of median income or our standard deduction. It's also reasonable for a deceased spouse to be able to care more for his or her surviving spouse than children or friends. So maybe 50 years of our median income makes sense, and maybe 250 years of standard income deductions makes sense.
The bequest to surviving spouse deduction shall be limited to the greater of 50 times our median income or 250 times our current standard income deduction.
And keep in mind, this is in addition to the other 20 years of median income and 100 years of standard deductions that can be transferred tax-free under the basic exemption we discussed earlier. So half of all joint assets would still not be taxable, and up to 70 years of median income or 350 years of standard deductions could pass from one spouse to another without any estate taxes due under the basic exemption and the bequest to spousal deduction. Also, based on the 2016 estate tax returns, this cap on marital deductions would have only impacted estates above $10 million, but those estates would also benefit from lower estate tax rates suggested and tax code simplification. Okay, moving on. Current policy for taxable gift and gift tax paid. The gift tax code was consolidated with the estate tax code in 1976. Time for another knowledge check. In this scenario, Bobby is now alive again. In 2020 and 2021, Bobby can gift anyone $15,000 without taxes. So if he wants to give April $15,000, no taxes and no filings are due. Gift away. If he gifted above that, he would either have to pay taxes on that amount over $15,000 or take the gift out of his lifetime exemption amount, which was $11,580,000 in 2020 and $11,700,000 in 2021. If April was married to Garrett, Bobby could also give $15,000 to Garrett as well to do an indirect gift to April and give the couple $30,000 jointly. If Kate wanted to join the party, she could gift to both April and Garrett $15,000 each as well. So in this case, Bobby and Kate could gift $60,000 to April and Garrett, and any other couple for that matter, if they wanted to, and no taxes are due. But let's say they're feeling especially generous this year, and they want to give April and Garrett $1 million. $60,000 of that amount is tax-free because of the annual gift exclusion. The remaining $940,000 comes out of their lifetime exemption, which was $11,580,000 each, or $23,160,000 jointly in 2020. But it's now reduced by the $940,000 gift, so they can transfer $22,220,000 through gifts or as an estate without taxes. But the lifetime exclusion is indexed for inflation, so it increased to $23,400,000 jointly in 2021. They now have another $240,000 they can transfer later without taxes. So if it's really that easy to avoid gift taxes, how much was actually collected during the lives of all the estate filers and reported on 2016 estate tax returns? To the tables we go. 6,825 estates had adjustable taxable gifts of $21.27 billion in total. 5,329 states paid no gift tax at all. 1,496 states paid gift taxes of $1.91 billion in total. Thus, the government collected an effective tax rate of 9.46% per state. If this tax rate was intended to be closer to 30%, then the government intended to collect about $6 billion, and it came up short by about $4 billion, and had to finance or borrow that amount over the years to accommodate deferring taxes for those 6,825 Americans. Which made me ask the question, how much interest did the government have to pay on the money it borrowed because it didn't collect the $4 billion in gift taxes in the year the gifts were made? And the answer? I have no idea, because the data does not seem to be available to the public. So instead I made this chart, which shows possible interest rates the government might have borrowed at from 1 to 6%, and how many years the taxes might have been deferred or financed by the government from 5 to 30 years. On the low end, the government borrowed $4.14 billion at 1% for 5 years. It spent $211 million in interest. If it borrowed at 2% for 10 years, it spent $907 million in interest, or 4 times more. If it borrowed at 3% for 15 years, it spent $2,321 million in interest, more than half of the original gift tax bill that was due, and that's not good. If it borrowed at 5% for 30 years, the interest cost was $13.7 billion, more than 3 times the original gift tax bill, and that's really, really bad. And if it borrowed at 6% for 30 years, it spent $19,655 million in interest to delay collecting $4.14 billion in gift taxes. And if that's a number, it is no wonder why we are imploding with national debt right now. My guess is that the true bill is somewhere between here and here. Okay, so how do we fix this? First, we separate the gift tax code from the estate tax code. We lower the gift tax rate and implement the same 25% flat tax as before on all taxable gifts, but we collect taxes due in the year the gifts are made to reduce the interest cost to the United States government. And because I hate fraud, let's increase accountability and fraud penalties here as well. But collecting taxes due in the year of the taxable gift is the key point, because the government can reduce its interest rate expense and increase its revenue to decrease deficits. Example:
in order to promote democracy, government fiscal stability, and tax code compliance, taxable gifts amounts above the annual exclusion shall be taxed at a flat rate of 25% in the year the gift was made. Any estates or related parties found transferring property improperly to circumnavigate or avoid gift or estate taxes will forfeit the ability to use the annual gift tax exclusion amount, and both parties of the transaction will be liable for a penalty equal to 25% of the original gifted amount.
Because taxes are what we pay for a civilized society. So says Oliver Wendell Holmes, Jr., former U.S. Supreme Court Justice. Let's move on to charitable deductions. Currently, unlimited deductions are allowed. In 2016, $20 billion in charitable deductions were claimed on an estate tax return for this deduction. In the 40% tax bracket, that saved $8 billion in potential taxes due for 3,044 Americans, or about $2.64 million each in taxes. But let's be honest here. Charitable donations after death are not as noble as those made during life for 2 reasons. Reason number 1, assets can no longer be used by the deceased individual for his or her enjoyment because he or she is dead. And reason number 2, potential estate taxes aren't imminent, so for every dollar you donate, there's a good chance that you're donating 40 cents of your estate tax bill. If you are below the 11.58 million threshold in 2020, you could give your estate to anyone, including charity, and no taxes were due anyways. so this deduction didn't matter to you. Here are some other observations that influence my recommended fix on this deduction. Observation number 1. Recent abuse by political, religious, and education institutions warrants a deeper dive into our charitable organization system and the corresponding tax code, a dive I have not completed yet. Observation number 2. Charitable donations are just gifts to charitable organizations, which seems obvious, but opens up a whole nother line of questioning because the gifts to charities are treated very different than gifts to other entities or people. So until I research this topic more, here's my tentative fix. Move the charitable donation deduction under the proposed separate gift or transfer tax code. Taxes on gifts made above the annual gift exclusion amount will not be enforced on gifts to qualified charitable organizations. Example:
It should not be the place of the U.S. government to promote or favor one citizen's voice over another, one press over another, one political body over another, one domestic corporation over another, one religion over another, one university over another, but tax deductions and politicians often do. It is equally important that government not impede on individuals' rights, collective progress, or conservation efforts. Thus, the prudent action the government should take is the one of least influence or distortion. Individuals may make tax-free charitable donations through their basic estate exemption, but donations above the basic estate exemption are not a separate deduction. Gift taxes on amounts above the annual gift exclusion amount will not be enforced on transfers made to qualified charitable organizations.
This is slightly controversial, unless you spent thousands of hours reviewing our tax code and our current financial situation, which I have. So let's move on to state estate tax deductions, or the death tax. Currently, they're 100% deductible at the federal tax level. In 2016, $2.490 billion in state estate tax was claimed as a deduction. In the 40% tax bracket, that saved $994 million in total federal taxes for 2,591 Americans, or $384,000 in average taxes each. The problem with this deduction is that it only helps 18 states and the District of Columbia, because the other 32 states don't impose estate taxes. So if you don't want to pay estate tax, just move. Move anywhere in the gray area, and you're good to go. Thus, state estate taxes are 100% avoidable. So let's simplify our tax code and eliminate this deduction. And while we're at it, let's do the same thing with estate taxes paid to foreign countries, because that is avoidable too. In 2016, 113 estates, meaning Americans, were able to reduce taxes paid to the United States government on average by $727,000 because they owed foreign countries estate taxes under their estate tax codes. And I can't tell if it was business property, vacation homes, or because they were a dual citizen. 10 people were able to avoid $2,072,000 in U.S. taxes each because of this deduction. These expenses are avoidable if desired, so this deduction is 100% avoidable if desired. Let's simplify the tax code and eliminate this credit. We're on a roll, so let's not stop now. To see spousal unused exclusion. Currently, Americans can gift unlimited wealth to spouses with no taxes due. And if they do transfer their entire estate to a surviving spouse, then they didn't use a single dollar of their basic estate exemption, which is $11,700,000 in 2021. Under the current law, because of portability, individuals can convert the unused portion of that $11,700,000 exemption into an exclusion and give that to their surviving spouse just like it's an asset. It's called a deceased spousal unused exclusion. The surviving spouse could then pass $23,400,000 to future non-spouse heirs tax-free, or $35,100,000 if they outlived two spouses and received full deceased spousal unused exclusions, or $128,700,000 tax-free if they received 11 deceased spousal unused exclusions, which is how many spaces the IRS provides you on the estate tax return form. In 2016, $3.730 billion of these estate exemptions that were converted and ported to the surviving spouse were claimed. In the 40% tax bracket, it saved 1,082 filers $1.49 billion of taxes total, or about $1,380,000 each. What's crazy is that we authorized the transfer of deceased spousal unused exclusions after taking the unlimited spousal bequest deduction. Another way to look at this is if there are 300 million Americans alive today, and there are, who were born with the unalienable right to transfer $11,700,000 upon death, as it now stands in 2021, there are $3,861 trillion of estate exemptions baked into our estate tax code system on this exemption alone. And that's an insane amount. So let's just eliminate the ability to pass them around like they're freaking baseball cards. And I'm 100% aware that this exemption could still be structured through an ABC trust, but people should have to exert just a tiny bit of effort to earn an $11.7 million tax deduction. So let's eliminate this exclusion. Okay, so let's review all the proposed fixes to the estate tax code. The no change category. Debts and mortgages are still 100% deductible. And as a reminder, 1/2 of all joint spousal property does not have to be included in the estate process for the first to die. The following are still allowed, but would be capped. Estate expense deductions, capped at $198,000 or 3 years of median income. Anything above that, you cover your own bills. Marital deductions, capped at $3.3 million or 50 years of median income, so positioned at that level to protect houses, retirement accounts, and farms, not stocks, vacation homes, and art collections, and that seems fair. Basic exemption, capped at $1.3 million or 20 years of median income, so you can give your spouse $4.6 million or anybody else $1.3 million and no taxes are due. Now for the ones that were eliminated to simplify the tax code and help to justify lowering the estate tax rate. Eliminate the following. The state estate tax deduction, eliminated. That would have only impacted 2,591 estate returns out of 2.7 million deaths in 2016. Credit for the foreign estate taxes paid, eliminated. That would have only impacted 113 estate returns out of 2.7 million deaths in 2016. Deceased spousal unused exclusion, eliminated. That would have only impacted 1,082 estate returns out of 2.7 million deaths in 2016. So at most, this would have only impacted 3,786 total deceased American estates out of 2.7 million deaths in 2016. How about the deductions moved to a separate transfer tax code? Charitable donation deductions, moved. That would have only impacted 3,044 estate returns out of 2.7 million in 2016. Adjustable taxable gifts made, moved. That would have only impacted 6,825 estate returns out of 2.7 million in 2016. And by association, gift tax paid, moved. That would have only impacted 1,496 estate returns out of 2.7 million in 2016. And last but not least, let's lower the top estate tax bracket from 40% down to 25%, a 15% reduction, and make it flat while we're at it. Now, what would have been the impact of all these fixes towards helping us solve the national debt crisis? Let's find out. On the top, we have the information for the average tax filer from each of the wealth brackets in 2016. Below that, on the second row, the adjustments for the proposed fixes. Below that, on the third row down, we have the impact of those changes for the average estate tax filer. And finally, below that, we have the net change to aggregate taxes, which would have been the impact on national debt for each fix. This is very exciting, so let's see what happens. Gross assets, no change. The average assets on the 2016 estate tax returns were $14,693,544. Proposed fixes, none. Net change to the average individual, none. Net impact on national debt, none. There's still $197 billion in aggregate assets. Next, debts and mortgages. The average debts and mortgages on 2016 estate tax returns were $936,817. Proposed fixes, none. Net change for the average individual, none. Net impact on national debt, none. $8.7 billion was claimed and deducted. $8.7 billion can still be claimed and deducted. Next, funeral expenses. The average funeral expenses claimed on 2016 estate tax returns were $17,470. Proposed fixes, combine this deduction with these three other categories and cap how many can be claimed, not spent, to lower your estate tax bill. At 3 years of median income, assumed to be approximately $198,000 in this table. If funeral expenses are the first of the four categories assumed to be deducted by a filer from the allowable $198,000 cap, the net change to an average individual is nothing, unless you spent over $198,000 on your funeral, and if you did that, that's on you, not other taxpayers. No change to the average individual, no change at the aggregate level. $195,871,000 was claimed in deductions. $195,871,000 can still be claimed as a deduction. Now, this is where I had to make some assumptions, because it's impossible to tell which of these 7,482 individuals who claimed other expenses and losses also claimed attorney fees or executor commissions. So I assumed that if you paid an attorney to settle your estate, you didn't pay an executor, and vice versa. I also assumed that the maximum you might spend on either of these two categories was $60,000, leaving $138,000 for your funeral and other expenses. So for estates that had between $5.45 and $10 million in assets, who spent $14,000 on a funeral, $43,000 on other expenses, $42,000 on attorneys, and $94,000 on executors, the only expense that was impacted by this cap was the executor commissions, and resulted in a reduction of $34,261 of deductibility from that expense because of the $198,000 cap. In the $10 to $20 million estate range, other expenses, attorney fees, and executor commissions were all impacted by the $60,000 assumed cap. So 43,000, 23,000, and 121,000 of those deductions were disallowed because an individual can only claim up to 198,000 of these expenses because of the cap. In the $20 to $50 million estate range, the deductibility of the three categories are assumed to be reduced by these amounts. And in the $50 million and above estate range, the deductibility of these categories are assumed to be reduced by these amounts. Americans claim $735,529,000 in other expenses and losses on their estate tax returns. The 3 years of median income, or $198,000 cap, would have disallowed $366,409,000 of these expenses as a deduction, and thus it increased taxable estate assets by that amount, because basically it asked anyone with an estate over $10 million to pay for more of those expenses, like an appraiser or storage fees, associated with distributing his or her estate. 7,570 Americans claimed $582,706,000 in attorney fees as a deduction. The 3-year median income cap of $198,000 disallowed $213,261,000 of these expenses, and thus increases taxable estate assets by that amount, because it basically asks anyone with an estate over $10 million to cover a greater share of the money he or she spent to an attorney to settle an estate. And 2,823 Americans claimed $555,192,000 in executor commissions on estate tax returns in 2016. The 3-year median income cap of $198,000 disallows $385,751,000 of these expenses and increased taxable estates by that amount, because it basically asks anyone paying an executor more than $60,000 to settle their estate to cover a higher percentage of that bill. Combined, capping the deductibility of these expenses at 3 times our median income would increase taxable estate assets by an estimated $965,421,000, or about $1 billion, which is honestly a relatively small number at less than 1% of gross assets, but it's a start. How about bequest to spouses? The average bequest to a spouse on a 2016 estate tax return was $9,805,868. Proposed fix, cap it at 50 years of median income, or roughly $3.3 million. The estates with $5.45 to $10 million in assets who bequested $3.5 million on average would only lose about $243,000 on average of this deduction. The estates with $10 to $20 million in assets who bequested $8.5 million on average would lose about $5.2 million on average of this deduction. The estates with $20 to $50 million in assets who bequested $21.3 million on average would lose about $18 million on average of this deduction. And the estates with over $50 million in assets who bequested $96.1 million on average will lose about $92.8 million on average of this deduction. Thus, the 6,662 Americans who claimed $65,333,357,000 in bequest to spouse would only be able to claim $21,894,600,000, or $3.3 million each, which would increase the taxable assets by $43,348,757,000. Now that's a dent. And before you have a heart attack about raising taxes, remember that I propose to lower the tax rate from 40 down to 25%. So please hear out the total plan before you hunker down to defend tax deductions that you probably won't ever get to take. Next, charitable deductions. Here are average deductions taken on 2016 estate tax returns by 3,044 Americans. Proposed fix, move this deduction to a separate transfer tax code along with gifts. So the estate tax code would not cover charitable deductions, so there would be no deductions here. They'd be covered under a separate code. At the aggregate level, this increases taxable estates by $20 billion. Next, state death tax deductions. Here are the average deductions taken on 2016 estate tax returns by 2,591 Americans. $409,000 to $6 million, which is also quite a range. Proposed fix, eliminate this deduction because it only helps 18 states in the District of Columbia, and it's completely avoidable. So all these deductions are removed. At the aggregate level, this increases taxable estates by $2,485,875,000. Okay, the average taxable estate was $7,885,672 in 2016 and ranged from $4.5 million to $58 million. With the proposed fixes, the average taxable estate is now $10,258,727 and ranged from $4.7 to $146 million. So estates in the $4.5 to $10 million range have to pay 25% tax on $243,000 more in assets, or about $60,000. Estates in the $10 to $20 million range have to pay 25% tax on $1.38 million more in assets, or about $345,000. Estates in the $20 to $50 million range have to pay 25% tax on $11.3 million more in assets, or about $2.8 million more. And estates over $50 million have to pay 25% more on $87 million more in assets, or about $22 million. At the aggregate level, the taxable estates were $98 billion in 2016. With the proposed fixes, the new taxable assets would be $152 billion, an increase of $54 billion. Again, it's impossible to know which deductions overlapped with the SOI tables from the IRS, so I had to make an adjustment here. When I took the average gross assets and subtracted the actual debts and mortgages, the capped index funeral type expenses, the capped spouse bequest deduction, and removed charitable and state death tax deductions, I got these taxable estates times these number of filers equals this estimated taxable estate total of $152 billion, an increase of $54 billion. When I took the aggregate assets, adjusted for the eliminated aggregate impact of each fix, I got an estimate of $164 billion, or an increase of $66 billion, which means there's a $12 billion difference. And since I wanted to err on the conservative side to make the estimates as robust as possible, I made the downward adjustment here of $12.5 billion in taxable assets, which brings the numbers back into alignment. Taxable gifts would not be covered under the estate tax code anymore, so they would no longer be included in the estate tax calculation. So these taxable gifts would no longer increase the average taxable assets for individuals, or at the aggregate level. So at this point, the taxable assets of the $5.45 to $10 million estates is actually $731,000 lower. The taxable assets of the $10 to $20 million estates is a slight $100,000 higher. The $20 to $50 million estates have about $8.5 million more in taxable assets, and the $50 million estates and above have about $81 million more in taxable assets. At the aggregate level, the fixes have increased taxable assets by $34 billion. The tentative tax was calculated with a top marginal bracket of 40% before. The average tax bill was $3.6 million and ranged from $2.1 to $25.8 million. The proposed fix was to lower the estate tax rate to 25%. If that was done, the average tax bill would actually be lower at $2.5 million and range from $1.1 to $36 million. All tentative tax bills are lower except for estates with $50 million or more. At the aggregate level, I've actually lowered the estate tax revenues by $8.5 billion, which is not what you want to do when you're trying to solve the national debt crisis. Now, if taxable gifts are not in the estate tax calculation process, then gift taxes won't be either, which means there are no credits for that here or here. So the tentative estate tax calculated with the 25% flat tax rate moves here. Now keep this in mind. If the 25% gift tax was imposed on the $20 billion in taxable gifts, as suggested in the year the gift was made, it would generate $5 billion in taxes, which helps to cover some of that $8.5 billion tentative estate tax loss I structured. But I still need at least $3.5 billion more in tax revenue just to break even. Here are the credits 113 Americans took for that foreign estate tax paid, which would be eliminated here, and reduces the average individual credits here. So there is an increase of $82 million in tax revenue here, which helps, but not by very much. But when you eliminate the deceased spousal unused exclusion, which lowered the average tax bill for 1,082 Americans by an average $1.3 million each, you gain $1.5 billion in tax revenue. And when you lower the basic estate exemption from $5.45 million in 2016, which is actually $11.7 million in 2021, down to $1.3 million, which is way more in line with historic norms, the effective credit drops from $2.2 million in 2016 to $330,000 under the proposed fix, and increases expected tax revenue by $25 billion. Thus, the final net estate tax bill that was $1.6 million on average, with a range of $272 to $21.6 million, is now $2.2 million on average, with a range of $869,000 to $36.2 million. Lower estates pay about $596,000 more, and larger estates pay about $14.5 million more on average. The net estate tax bill increases from $20.4 billion in 2016 to a new estimate of $33.9 billion, or $13.4 billion more towards solving the national debt crisis. But keep in mind, the taxes that would be collected on taxable gifts are $5 billion, and there would be interest savings from not having to finance the deferred gift taxes for decades, which are not included in this analysis. Also, since the tax-free threshold was reduced from $11.7 million for individuals in 2021 and $23.4 million for couples to $1.3 million and an additional $3.3 million kicker for surviving spouses, the number of individuals who would be filing a tax return would theoretically increase. And that's not a bad thing when you're trying to solve the national debt crisis, and the number of people filing the estate tax return is the lowest in over 100 years. So total, I think these fixes would increase estate tax revenue to $52 billion, or $31.5 billion more than the current plan, while reducing the top tax rate from 40% to 25% and simplifying the tax code, but still allow Americans to pass 70 years of median income to surviving spouses without taxes to provide for them, 20 years of median income through the basic estate exemption, and 50 years of median income through the spousal bequest deduction. And if your only rebuttal to this analysis is that you don't like taxes or the idea of an estate tax, that's fine. I don't either. But I'll tell you what I don't like more. Racking up trillions of dollars of debt with the expectation that our children will pay it off for us. Because that's not a plan, that's theft. If anyone out there is working on a solution to national debt and has a better plan, please send it my way and I'll review it. And if it's better, I'll scrap this one. But until then, this is what we got for the estate tax fix. Subscribe to my channel or blog to track my progress on solving our national debt crisis. I'm Stephen Plugo with Watchguard Capital. Invest your time wisely.